Hi, this is Dustin with Dustin's Dollars. Today I'm going to be talking about Enviva, going over their sort of a deep dive on the debt that they hold as of the end of Q2 2023, and also going to talk through a couple other of the downside risks that I see. Um, yeah, before I begin, let me remind you that I'm not a financial advisor or a financial professional of any sort. All opinions I express in this video are mine and do not represent those of any company or any other individual. I currently hold a long position in Enviva, so this video should be for your entertainment purposes only. Because I could be wrong about everything I say in this video, you need to do your own research before making any investment decisions. Okay, so Enviva's debt, I think this is one of the things that probably plays into, let's say, if I was going to make a shallow bear thesis, bear case on Enviva and why it's going to go down, why people might have sold it down all the way to the prices that it's at now, trading under $4 per share. One of the things when you look at the company is their balance sheet looks pretty bad. They have a nice summary here on their investor presentation, and they say, hey, we've got $156 million of cash. That doesn't sound so horrible, cash and restricted cash. But then you look at it and you say, but there's, roughly $1.4 billion of debt in total. And so you're like, okay, so they have 10 times as much debt as they have cash on the books. And then if you even look in more detail, you open up their balance sheet and you say, well, in terms of actual cash, at the end of the quarter, they only had $2.3 million. $2.3 million of just unrestricted cash. And the rest of it was long-term restricted cash, right? That's $153 million. Hi, Wakaza. Thanks for hopping on the stream. So they have, you look at this and you might say, well, so this is all restricted cash, so they can't just use this, for whatever they want. And I'll go over what this is restricted for in a moment. And then you scroll down and you look at it and you say, and that's against roughly, as I said, $1.4 billion of debt. This also includes some leases, but then they have more debt that's listed up here, and it just looks pretty bad. You're like, okay, they've only got $2 million in the bank and $1.4 billion of debt. When are they going to run out of money? And I think there's a couple things that sort of misses. One of this, and it's not really obvious. You can look through this through the quarterly filing. I don't even think it goes into detail. One question you should ask when you look at debt is, when is it due? And really, if you go over some of these are a little bit nuanced in terms of what they are. They're not all just standard bonds. So to go through these really briefly, they have this term loan, which is this term loan and this revolving credit facility, which kind of go hand in hand together. In terms of the rates, I think are roughly the same. They also have the 2026 senior notes. Those are standard bonds. That is their largest portion of debt, right? So that's $750 million of, face value. Then they have these tax-exempt senior bonds. They have some for Alabama and some for Mississippi. These are for the two plants that they are either in construction now or sort of maybe in designing and sort of deciding if they're going to actually go forward and start construction or not. In the case of the one in, I think it's Mississippi. I think the one in Alabama is already under construction. Might have those reversed, but I'm not sure. But this debt is not due for a very, very long time. If you look in their annual report, you can see when it's due. And if I scroll down, it will say, and it's actually really surprising. Here's the ones for the EPs or the EPs, however you say this. This is the site in Alabama. These are tax exempt green bonds, and they say these are due in full. Matures in full in July 15th of 2052, right? So they've got a long time to pay these back. Similarly, the other ones, the Mississippi, they call them Mississippi tax-exempt bonds, probably to make it a little less confusing to say that they are the bond, tax-exempt green bonds. Bond is the name of the city in which that plant is being built. And these are also due very, very far in the future. They mature in 2047, it's right here. They mature in full on July 15th, 2047. So those, those bonds in particular are way, way, way out in the future. And some of this money they're still holding, and this is also why it's restricted cash. I mentioned that up front, that they only have $2 million roughly of cash on hand, but then they have about $150 million of restricted cash, and this is where that money is coming from. And so it's restricted; it has to be used, as far as I understand, for those particular plants. And as I said, then they have just a little bit of the rest of it. Let's not worry about, right? It's $50 million, which, not that that's not significant, but in the scheme of things, that's, roughly, it's less than 5% of their total debt. So it's not that big of a deal. The revolver, they currently, as of the end of the quarter, owed $155 million on it. That's what they'd drawn down. But I think they can draw down up to $400 million. Let's see if we can find it in here real quick. I guess it would be, this is senior secured credit facility. Yeah, and so they have, as of the end of 2022, they had $436 million in, I don't know, sorry, that's the outstanding borrowing. Where's the max? I'm sorry, I thought I had it up, and that must not be it. But clearly they can borrow up to $400 something million as of the end of this quarter. It's listed here. They had paid that down, and this was the actual the equity transaction that they did, where some insiders and some of the existing shareholders, purchased more of the stock to the tune of about $250 million. If I recall correctly, they used that to pay down the credit facility in somewhere around the end of Q1, beginning of Q2. And so that's why this balance is back down. And so they have all that cash that they can, this revolver that they can draw from as they need to. And, sort of getting back to, and this is not really the focus of today's video, but as I said, their actual profits for the year, they guided this, that they're going to be very, very heavily backweighted. And so really in Q3 and Q4, in terms of the actual business, they should be bringing in cash. Now, cash is going to be going out the door in terms of CapEx to build these plants and do a couple of the expansions they have planned. But, in general, those are capital expense, right? Those are expansions, not necessarily just operating the business. And so the fact that they didn't have much cash on hand at the end of Q2 is kind of indicative of the fact that, they didn't really make that many profits. They were managing very closely, and now that the profits are really going to come in Q3 and Q4, according to their guidance. But getting back to their debt here, we can see that they don't have a lot that's due anytime soon. I kind of put in a spreadsheet here. Hopefully you can see this. I probably ought to be able to make it even a little bigger. So you can see they have the revolver. At the end of Q2, they owed $155 million. And same with the term loan, $104 million. Those aren't due until the middle of 2027. The senior notes are due in the beginning of 2026. That is significant at $750 million. But then the rest of this is not due. They have this small loan. I didn't mention it, but this $30 million of that sort of other debt was this this new market tax credit loan. That's what they call it. That's not due until 2029. So nothing is due until the beginning of 2026. Granted, that is $750 million, but if you really look at things, there's a lot of time between now and then, right? We're talking, 2 years, 2 years plus 2 years and change in the future. And by that point, if they're able to deliver anywhere close to what the guided numbers are here, because this is what they guided for 2023. I think 2024, if you read what their implications and some of the improvements that they're making, these should last. So 2024 should be even better than 2023 in terms of EBITDA. And so, you have 2024 and 2025 for them to sort of improve the business, to expand, to get a lot more cash on hand. And if that happens, I don't think they're going to have a whole lot of problems refinancing this. They may be able to even pay off a portion of this $750 million and, refinancing it to extend the maturities out. And so I really don't think that that's a big concern for the stock as of right now. Again, this is assuming they meet this guidance or come anywhere close to it. If they're failing on the guidance, then yes, if they're not able to actually make profits, in Q3, Q4, and then especially throughout 2024, that's when you need to start really worrying that they're not going to be able to get not going to be able to refinance, or not going to be able to get good terms on the refinancing, when these are coming due in 2026. But, again, everything hinges, in my opinion, on this, them coming close and meeting this guidance and actually improving the operations, which, again, I think is sort of it's going to be sort of a double whammy if that happens, because not only is it going to relieve some of the pressure on, people thinking that they're going to be able to pay back this debt in 2026, it's also going to be profits coming in the door. So that's kind of my rough, my overview of the debt and my opinion on that. Now, I did want to talk through, this is going to be hopefully brief, but some other of the downside risks. I think one of the other really big ones for Enviva that we need to worry about is legislation. And I know this was a big deal. They have this renewable energy directive. They call it RED 3. I think it's a third iteration of this renewable energy directive in Europe, and this was a big deal for Enviva. And they came out with this press release, at the end of March, and they said, basically, we're pleased that the initial draft of this thing, of this legislation, has provisions in it for primary woody biomass, which is basically what they produce. And they have some other things in here that are positive statements about what was in that text. Now, I tried a little bit to actually find what the original draft of this text was, to be able to then compare it against what the current version is, what I think was actually adopted. And I couldn't 100% find that, but what I could find is this. Let me see if I can zoom in a little bit and try to find some passages here, just at least one or two. So this, I believe, is what the EU actually adopted. They have these votes that happened in September on these. And it does still talk about woody biomass. It talks, let me see if I can find, there's a specific, so sorry, I'm drawing a link between, they even said in Enviva's press release from March that it included, let me find it, somewhere in here, that it still included existing subsidies, continuing availability of financial support to electricity-only installations where they have this, carbon capture and storage technology, basically, and assurances that electricity-only plants already receiving subsidies will continue to do so. And so I was trying to find, some of this stuff in here, and let me see if I can find this. Let me see. Yeah, so here it is. Member states should not... So this sounds negative, but I think it's a positive, right? So let's read this. Member states should not grant new support or renew any support for electricity-only plants unless the installations are located in regions with a specific use status as regards their transition away from fossil fuels, or something else, or the installations use carbon capture and storage. And sorry, I should have mentioned this entire paragraph here. This whole thing is talking about the use of biomass, right? There's a bunch of they talk a lot about biomass in this thing, but this was, I see this text in here and it makes me think that yes, they do still have, they're still including, woody biomass in all the list of things